Hi, my name is Amar, and today we have Kyle. Kyle is part of the Fidelity charitable side of the business, and we're going to talk about gifting assets that are often overlooked. And Kyle, what does that mean? What are assets that are overlooked?
Yeah, thanks, Amar. So I think it's really important to take a sort of a step back and realize that nonprofits today have made it so easy for people to give cash. There are donors to be able to give cash, whether that's their credit card online, whether that's writing them a check or doing some type of EFT or wire transfer. So nonprofits like that because it's cash readily available, making it really easy for donors to do it on their website is sort of the value add across the board. But what a lot of people really don't realize is that cash is the most inefficient asset to give to charity, right? So taking a step back, looking at the bigger picture, in order to actually have cash in your checking account, you have to either earn it as income, and as California state residents, we know that that income tax is high from the federal and state tax, right? Over 50% if you're in the top tax bracket, or you have to sell an appreciated asset and then pay capital gains on the growth. So what a lot of folks realize is that, hey, I'm giving cash to nonprofits, but it's not really tax-wise the best asset to give. So what we're talking about today is mostly the value of giving often overlooked assets, and that really starts with appreciated stock, right? So folks that are investing in an individual brokerage account, non-retirement accounts mostly, will look at the value of giving appreciated stock. And this, what you're seeing on the screen is really the example of doing so. So this is an
Yeah, so let's
example.
share that now.
Yeah, perfect. So really what we're looking at is an example of somebody that invested $300,000 in an individual stock, and now that security is valued at $450,000. So what we'll see is this side by side, where you'll look at the fair market value of the stock at that $450,000 level, and what you'll see on the left is the column that suggests somebody selling the appreciated asset, paying the tax, the capital gain tax on it. And keep in mind, this is just federal, not even taking into California or other state taxes as well. And really showing the tax and philanthropic impact of doing either that, selling the asset, paying the tax, and then gifting the after tax cash, or that same individual gifting those securities directly to the nonprofit. So what we'll see here on the left-hand side, the capital gains tax is a little bit over $35,000 on the federal side, leaving about $414,000 to give to charity. Charity gets that $414,000. Donor ends up being able to write off that $414,000. But on the right-hand side is really the value here, right? Where somebody is gifting the pre-tax dollars in their investment to a nonprofit or a strategic giving vehicle like a donor advised fund. They're getting able to take that $450,000 deduction. The charity gets $450,000. So we're talking about an increase of over $35,000, both on the tax deduction and the amount that charity has to use towards their mission. So a lot of value there.
Yeah, that you can see the numbers there just side by side. That's almost an extra car just in the capital gains tax savings. So well, it used to be the cost of a car. I don't know today with inflation, right? But so what are other assets? Because okay, you have publicly traded stocks that appreciate, but I'm assuming you can also have businesses that have appreciated. You can have works of art that have appreciated, or jewelry. So maybe give us some other examples of uh, more overlooked assets to give to charities.
Yeah, it's a good question. So when I always, when I talk to clients or donors about charitable giving, we always try to target the asset with the highest percentage growth in their portfolio, right? So that might not be this investment that is appreciated quite significantly. This might be something like real estate holdings or private business interest, or if you invested in a private equity fund or a hedge fund, or what's really popular now is cryptocurrency, right? So these early investors have 10x plus growth in their investment. And the reason why you give that most appreciated asset is that at the time of sale, that's the asset that you'll pay the most in taxes on. So even looking back at the example we went to before, it cost that person $300,000 to take a $450,000 tax deduction and give to charity at that level of $450,000 as well too. So the same applies with other assets as well. Anything that's highly appreciated. And then you also mentioned before about sort of tangible personal property, like cars and collectibles and jewelry. And the IRS actually has this related use clause that says that you'd have to give an asset like that directly to a nonprofit in order to get a fair market value tax deduction. That nonprofit that actually uses that asset in their mission. So, like for example, if you have something like artwork, you'd want to give it to a museum or maybe like a hospital that would have that built into its mission in order to take advantage of the tax benefits right away. Giving that same asset to a strategic giving vehicle like a donor advised fund or a private foundation only allows the donor to take a cost basis tax deduction.
Yeah, so that's, so like I think like for those individuals that have these family businesses that they've been growing for a long time, and now they have a chunk of it, or they're ready to sell because the next generation doesn't want to work in the family business. Mm-hmm. This could be an opportunity. And I think like the one thing that I think we should make clear is that before there's any sale of anything, you have to engage with a professional like Kyle to kind of get some of that piece of the business ownership structured correctly prior to the sale of any business or personal assets, real estate, what have you. Is that correct?
Yeah, exactly. The planning is very important, and making a gift of a non-publicly traded asset, you need to do it before the sale process is finalized. And that's usually the purchase and sale agreement in a private business. That's usually when a piece of real estate is under a contract. The IRS has this clause called anticipatory assignment of income that says that you need to make that gift before anything legally binding is in place between buyer and seller, or else a lot of negatives, tax benefits are taken away, plus paying capital.
Yeah, it's huge because I actually know of a case where somebody was selling a house, and in escrow they put a clause that they could replace the proceeds of the fund to go to their donor, like another charity or something in there. Mm-hmm. And the IRS said no because that wasn't done prior to the sale to kind of get that language in there. They already had entered into agreement. Mm-hmm. And so, all right, this was great. So like, if you're giving to charities out there and you're looking for a more tax efficient way, maybe look at assets that are not your traditional assets. And obviously that's cash being the most traditional, but then going one step out being securities, another step out being your non-publicly traded stuff, as well as real estate and family businesses. So if you have any questions, please reach out. Otherwise, thank you for joining us. Thanks, Kyle.
Thanks, Amar.